Let's not we get down to chapter 11 today. Oh, it's where it started. Okay, who can tell me how to get rid of this thing? It keeps popping up. Anyone? Okay. Wow. Let's see. Chapter 11. Okay, chapter 11. It has to do with accounts receivable. And accounts receivable is actually as an auditor, it's one of those things that is often used for fraud. So one of the things that companies always look at are their sales. They'll say, what are the sales from one year to the next, one quarter to the next, whatever. And so one of the things that they're always trying to look for is higher sales. Now, you can show sales for cash like this, or you can show a accounts receivable, like this. Now, if you're going to cook the books, there's a problem with using cash, the cash entry. What is it? So I'm going to cook the books. And I'm going to say, okay, I'll put a fictitious entry for cash in and a sales revenue. We'll say that we had a cash sale of $1,000. Why is this kind of a stupid way to do it if you're going to cook the books? Anyone? Why would this first one, the yeller one, why would that one be not such a good one to do if you're going to try to cook the books? What's going to be missing? Anyone? What's the problem with this journal entry here? You're not going to have the cash. If you're just making up this journal entry, if you're not actually selling this to somebody, there's no cash coming in. That's a problem. Because this will be caught, immediately, hey, where's this cash coming from the sales revenue? And one of the ways that they catch fraud, for instance, the Enron case, one of the reasons how they caught it was through the statement of cash flows. Eventually, everything will go through cash, and if it doesn't show up, it doesn't show up. There's a problem. So the accounts receivable ends up being a uh, a more likely target for someone who's going to cook the books. And they can do it in a couple of ways. Why is a credit sale more susceptible than a cash sale? Uh, the journal entry for cash can be easily discovered through the bank statement. in order the bank reconciliation, if the people doing the bank reconciliation are on board. So that's why. And the question is, well, how do you do it? You're wondering why I'm telling you how you do it is because we have to be able to look for it. So if you're going to cook the books, two different ways you can do it. First of all is set up a fictitious customer. We'll call this fraud one. Okay, so first thing you do is set up a fictitious customer. Some goes on credit. And we'll figure out how we find these things, by the way. Okay, constitutional fraud number two. Send goods to an existing customer. That they did not order. This is called channel stuffing. And usually channel stuffing, they don't do it very much anymore because there's accounting rules that kind of stop it. But channel stuffing is when you overship. And usually it's not at the end of the year. And it's done to increase the sales. And you know you're going to get that whoever you're sending it to is probably going to send them back whatever it is you sent, and they're not going to pay for them. However, at the end of the year, your sales look good. So these are kind of the two ways that two things that they do for kind of for accounts receivable fraud. I think it's highlighting stuffing. I spell stuffing wrong? Oh. I think overship is one word, isn't it? That's what my English skills are not what they should be. My wife was an English professor. Not anymore. She used to be. I'm sure she would cringe if she saw me up here. All right. So one of the things so the documents that we have over accounts receivable accounting side. And by the way, this a lot of times this stuff comes down to when is the sale actually made and all that. It's the same thing whether you go to a store or not, that they have a lot of this comes down to like contracts and things like that. But believe it or not, like when you go to a store, you're actually involved in sales contracts. When you go up to a cash register and you want to buy something, a gallon of milk, you put it, you want to buy it for what they have, let's say they have it marked at whatever, $3. You put it on the thing. You are offering to buy that milk from them for $3. and they may accept that. Now, it could be that they ring it up differently, is they ring it up at 350. Okay, that your offer is now invalid because it's been replaced with their offer of 350. Maybe they have it marked wrong or something like that. And then you have the decision of, do I accept the new offer of 350? So if there is a change in the register. And so that all happens at the cash register, but those are contracts for sales. And it's the same thing, through accounts receivable. These are basically sales contracts, and when they become valid, that's when they can enter them as accounts receivable. Okay. Where is it? I think I know what the problem is with me in this computer. I think there's a delay. Okay. Customer purchase order. In business, oftentimes you'll have these business to business ones come and have these so a customer purchase order will be sent to the client, our client, whoever they are. For example, if it's IBM, if IBM's our client, then they get a purchase order from somebody. A sales order. The client, they are the company we're auditing. I'm gonna say IBM. Let's say we're auditing IBM. Make sales order from a purchase order if there is one. Okay. And the purchase order will generally have the quantity. Usually it mimics the purchase order, but not always. But the quantity, price, terms. What's that wrong? If these things are different, then the sales order is well, if it's different than the purchase order, the purchase order by law is rejected, and the new quantity, price, and terms are offered as the sales contract. Question on that? Now, a purchase order isn't always used. Sometimes it'll be something else, online and all that kind of stuff nowadays. But the purchase order are usually between companies, they are used. And here's why. When you have a company to company, they usually have standard people, customers, and vendors that they deal with. And they'll have lists of what they pay for stuff and what they sell stuff for. And so those are usually locked in, often for time periods of a year, 2 years, 3 years, whatever. And so a purchase order will generally match up with that list, whatever the latest list is from the company that's selling it. So oftentimes, if it's business to business, these are negotiated things, and that they'll have approved prices and things like that. So, and unless something changes, usually those are generally honored. I got way too much stuff loading on this. Okay. All right. Credit approval. One of the things that people sometimes don't grasp of, especially businesses, is that credit approval is huge. And you don't just sell it to anybody. Why don't you just sell it to anybody? McDonald's sells to everybody. Why don't you sell to everybody? Suppose you're dealing with IBM. Why doesn't IBM just sell to anybody? Why can't I just call up IBM and place an order? They want to know if they can get paid or not. So a credit approval is very important. They pick and choose who their customers are. They'll pick and choose who their vendors are. If you're a vendor, they'll often ask for your financial statements. Why? Because they don't want to know that if they order something, they'll get it. And if you're on shaky ground, they might not have you as a vendor. And the same thing with a customer. They're on shaky ground and they don't know that they get, they might not, or at least they'll try to limit what you have. Credit approval is done by either larger companies will have a credit approval, division. Smaller companies, should have larger business will have a credit approval department. Those are usually not, there's not usually not a problem with those. Those are very professional and they'll have all their rules and how they come up with their approvals and all that. Smaller companies, they may have their own approvals, but they should be individuals that are not involved in sales. You do not want to have salespeople doing credit approvals. And the reason being is that you can have fraud with that. They approve somebody for credit that they're not going to get paid. They send them the merchandise. Whoever gets it doesn't pay for it, but they sell it and they split it. And so you have a real problem sometimes with that. And so credit approval should never be made by anyone in sales, anyone who has contact with the customers. They should be separate from it. Okay. Pick list, packing list. Sometimes companies will have both, sometimes it'll be the same thing. They could be different, but pick list and packing list. Pick standard packing list should come from A. Should come from the sales order. The sales order will say, we're selling this to these people for this amount. It's been accepted. And they will try to fill it. Now, if they can't fill it, they should make that on the packing list, and it should also show up on the invoice. Because there could be something that is stock, they have stock outs or something. The sales invoice. Okay, the sales invoice, should it match the purchase order, the sales order, or the packing list? Which one? Which one? It should open the packing list is what we want. That's what you actually sent them. So the sales invoice should, oops, where am I at? You'll see sometimes in textbooks and stuff that they'll say that the sales invoice should match the client's purchase order. That's not true because even if these two match, if the customer's purchase order and the sales order match, it may not be what was sent. The sales order should match the packing list, what was actually sent. A. And collection of receivables should be coordinated with the credit approvals. I keep shipping to somebody who's not paying for it. Yeah, we're putting the ATs in. Okay, so up until this point, you get all this stuff: sales invoice, pick list, credit approval, sales order, customer purchase order. And believe it or not, none of those are very good evidence by themselves. It's a bunch of paperwork, but none of those are really very good evidence just by themselves. And there's a good reason why. For instance, why isn't the sales order a good piece of evidence? If you're worried about them, yeah.
What the others have been, moved from the company to a client. And so that is everything before the deal. Or something like has not fully been delivered, how we are coming.
That's exactly right. Exactly right. You don't know whether any of it was sent, and all these documents are generated by the client. So if IBM wanted to cook the books, I don't think they would. I don't think they have a reason to. But if they did, all these documents, the sales order, the picking, all this stuff, this is all internal. They could, print up another sales order and put it in the system, and by themselves, these things are not very good evidence. It's the worst evidence. It's made by the client. It's held by the client. Um, it's the worst evidence you can have. So you say, well, okay, why do we even bother with it? Well, we do bother with it because of these next things we have. I think these are on the next page. Bill of lading. This is this is maybe the most important document to tie this all together. The bill of lading, what it does is it transfers the possession of the goods to the transportation firm. So there's a third party involved here. And this is kind of the first place that a third party is involved. it transfers the possession of the goods. I should probably add something else to this one. Oh, don't do that. And that is, it does not transfer the title of the goods. This is a, they've had bills of lading for millennia. Um, they're very common. Okay, you have something that transfers. So for instance, you send something by UPS. UPS does not take title to it. If you send something through UPS, it does not own it. It will take it. There'll be a bill of lading or something similar to it. But they will not own whatever that is. They will agree to take it. They'll be responsible for it. However, they don't take the title of it. Notice the difference there between selling to a customer or something like that, where you go to the store, you buy the milk, you walk out with the milk. It's not like that because the goods are going to somebody, to the shipper, but they are not owning it. It will have the number of goods, the description, and the weights usually. Signed by the shipping department and the carrier. They'll sign off on it. They'll see what gets loaded. They will both sign off on it and agree to it. It has a seller and buyer's addresses. That's not that big, but one of the things is it does not usually have the prices included. You will not see the prices on the bill of lading. There's no reason to. The shipper is looking at the weights of it, how big it is, and the shipping it and all that kind of stuff. Now, if there is a problem with it, as far as insurance, then whoever's paying the insurance will have to settle that up, whether it's the shipper or it's the sender or it's the buyer. But prices are not included on it, and they're not included for a good reason. If I'm a trucker and I walk in and they have this stuff to be put on the truck, I can't tell what the value of it is. Right? I mean, you look at something, I don't know, looks worthless, but to me, it looks worthless, but maybe it's worth, a lot of money. I remember looking at wedding rings for my wife, and you look at these two rings, are they the same? No, this one's, all right. So anyway, same thing. The signing of those documents by both the shipper and the sender cannot, the value of them usually isn't verified at that point. So the prices are usually not included. It just says a description of what they are. Now, here's the beauty of this thing. If you are wondering if there is a sale that is valid, you can go pull up the bill of lading. It'll show that it was put on a truck, that there actually were goods put on the truck, whatever those goods were, you can match those up. I can match those up to the pick list. I can match that up to the sales invoice. Those are the things that should be on that truck. So now these things that are by themselves worthless are now helpful, because now we can match these up to the descriptions of what is on that bill of lading, and we can get that from a third party, somebody outside the company actually, that actually verified that those things were actually shipped. There's also a proof of delivery, and proof of delivery, nowadays everybody knows what these are, but if you ship something, they always take a picture of it on your doorstep, or like they always deliver all my stuff to the apartment building next door, next to an apartment building. So almost everything goes to the apartment building. So they'll show a picture of it. Oh, in the apartment building, go over that stuff. All right. We'll have the date of delivery, and it'll be signed by the recipient. Now, you might think that the proof of delivery is the most important one, but actually it's not. The bill of lading is the most important. Things get lost in shipping. That's not an unusual thing to have happen. The bill of lading, however, is proof that there was an attempt made by your client to sell something. So the bill of lading is actually a very important one, even more so than the proof of delivery. And if it was lost in shipping, okay, there's insurance companies and whatever you're going to get involved in. But the bill of lading actually is evidence that the sale existed. I should probably say occurred. That too many? It's going to flag that I don't. No? Did I spell occurred? I guess it is. And so this is very important. At this point, you will know that at least something was shipped. I'll tell you where it becomes trickier, though. How sophisticated they are at this fraud number 2. Because if they are sophisticated, what they will do is ship it. They'll actually ship the goods out as if they were sales. They might ship them to a warehouse or something, but they would actually ship something out so that they have this bill of lading that will fool you. Rookie mistakes are you make all the documents up and then you don't have this bill of lading. Without it, those documents are useless and it's caught pretty quickly. But yeah, so send goods to the existing customer that scratch that. This is fraud too. This one, fictitious customer. Again, there was a company called Regina Vacuums, and they were probably around before most of you guys were born. but there's a very big company called Regina Vacuums. They had stuff in all the stores, and they were caught in a fraud doing this. They were sending everything to a warehouse. And then rather than manufacturing more goods, they would go to the warehouse, pull them out of the warehouse and say, oh, look what we just manufactured. And there wouldn't be any cost of, so eventually that got caught. But okay, aging trial balance. This is to see the value of the accounts receivable. You guys, I'm sure, had this in your accounting classes. Only accounting 110 or 210. It will look something like this. Current accounts. Making up these numbers, $100,000. Estimated uncollectible. 3%. So you'd say, okay, $3,000 of these are not going to be collectible. Past due, 1 to 30 days. Let's say 20,000. Are we going to have more than 3% or less than 3% uncollectible? They're past due. Are they more likely or less likely to be paid? Oh, someone has a coin. Just flip it.
That's like,
Yep, less likely. Yeah, so maybe it's 10%. I'm just making these numbers up, by the way. Wait, do I want to do 10%? Yeah, I'll do 10%. I don't want it to. And so you'd go down the list here, and as things go out further and further, they become less and less likely to be collected. And this is an aging of accounts receivable, and virtually all companies do this. I'm not going to get into the accounting of it, but if those of you that are familiar with it, they usually use the income statement method for estimating them as the sales are made, and then at the end of the year, they'll do an aging of accounts receivable, which is a balance sheet method to see it, and they'll go past due, 30, 31 to 60 days and blah, 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 and depending on the company, how far they go out. But that's an aging of accounts receivable. And the longer something goes out being paid, the less likely it's going to get paid at all. And at some point, you have to start writing them off. Industry average for bad debt expense. This is a it seems very unassuming. This is one exception to a rule, though, that is kind of they tested a lot more than they probably should on the CPA exam. And that is this. This is what they call a analytical procedure. We're seeing if something is plausible, it's rational. However, those are generally not used as proof of errors or fraud, as misstatements, but they can be. It's one of the rare cases where it can be. If the company is, if their customers are the same as the industry and the industry average, if they're significantly different than the industry average, it might show that they are doing some kind of fraud. So this is actually an analytical procedure. I think it might be the only one that I can think of. Used, oops, as a substantive test. A substantive test is a test that's testing per dollar. Let me put this on a second. I don't know if you can say. So if IBM has customers that are similar to others in their industry, you can use the industry average as evidence that they may be using inappropriate numbers for their bad debt expense. Usually, analytical procedures kind of direct you in the right direction, and then you can take a look at whatever's going on. So, for instance, you look for instance, if sales go up, you'd expect the advertising expense to go up, right? It's a plausible relationship. That's what analytical procedures are. They're not usually evidence of any fraud or material misstatement, but this is one of those things that it can be. So using the industry averages for the bad debt for the expense. And again, this is one of those weird things that, while it's true, I think it gets tested more on the CPA exam than it probably is worth in real life. But anyway, sales journal reconciliation to the subsidiary ledger. The accounts subsidiary ledger should match up with the sales journal. And if it doesn't, you got to figure out why. Okay. Here is probably the most important thing. And especially for retail sales. Cutoffs. And actually, we're going to do one of these later on. of when something is sold. What would you, we've actually already talked about it. What would you do to figure out what was actually sold at the end of the year? What was the last thing sold? How would you find it? Well,
Maybe take a peek at the sales list.
I'm sorry, one more time?
Got the sales list?
The document you're actually gonna look at is this, the bill of lading, yeah. The last thing out should be the last bill of lading should be the last thing you look at as far as what was actually loaded on the truck. And you say, well, why does that matter? Because they might want to hold the books open and ship more stuff after the end of the year to make sales numbers or something like that. So the sales cutoff is very important in that it will the year-end cutoff we use a bill of lading. This is not just important for accounts receivable. It is important for accounts receivable, but it's important for a whole bunch of things. So it has to do with sales. It has to do with accounts receivable. If it was shipped out, it's usually an accounts receivable. If it wasn't, it's nothing. uh, it has to do with inventory. Notice if it's not shipped off, that should be in your ending inventory. If it's not shipped, it should be in your ending inventory. So these are all things that are affected by it, and so it can affect your income statement with the sales, accounts receivable, assets, inventory, assets. All those things are affected by the cutoff date. And that it could be overstated. And another problem that could happen is they hold the books open, but they count that inventory in their inventory at year end. That's actually a double whammy. Because the ending inventory is subtracted from the cost of goods sold. It'll reduce your cost of goods sold. So not only is it included in the ending inventory, it's the sale is fictitious, but it's also reducing the cost of goods sold by whatever the amount of that inventory is. That inventory is not appearing in the cost of goods sold. So the sales are overstated. The cost of goods sold is understated. That inventory that was, if it was counted and put in ending inventory at year end, but not shipped until the January or whatever the next, whatever their next period in their next period is. Those are all things that it'll be a double hit, a double fraud. So it's very tempting to do that, as you can imagine. You can count it as having it, and then also count it as being sold. Because it's not going to come out of that either, but they're included in their ending inventory. So the year-end cutoff, if you ask people, what's, especially for retail companies, what's the most important stuff? It's the year-end cutoff and determining when something was sold. And we look at that bill of lading. The bill of lading is usually what we use as the guide as far as what it was, is whether it was shipped or not. Bill and hold criteria is almost impossible to meet. So you say to someone, okay, I know, here's what we'll do. We can't ship it. Right? Okay, we can't ship this thing out. So here's what we'll do. We'll label it as sold. And we'll go stick it in the corner. Say, okay, don't audit, don't put this in inventory. This is sold, but we just haven't got around to shipping it yet, but it's sold. That doesn't count as a sale. If you still have it, if it's still on the premises, it's not a sale. there are very strict guidelines. There, it is possible to have it, a bill and hold, but it's usually done at the request of the buyer, and usually it's for some specific situation. Like, hey, our warehouse burned down, can you not send that, because we have no place to put it, that kind of thing. So a bill and hold, there's specific criteria that is very difficult to, it's not just, hey, we can't ship it out. If you have it on, if they have it on the premises, basically, it is not sold. Okay, let's do pledging of accounts receivable. Pledging accounts receivable. Accounts receivable may be used as collateral. For a loan. It's also possible that accounts receivable may have been sold. So even though they have the accounts receivable, they don't own them anymore. They're not their assets. So one of the things when you're doing auditing is you want to see if they are doing either of those two things. If they are, the accounts receivable are used as collateral, if it's being pledged, it could be pledged as collateral, it could be, or it could be sold outright. By the way, where, if it was pledged as collateral, where would you find it? It actually goes back to chapter 10. Yeah, the bank confirmation. This would be on a bank confirmation. You look on the bank confirmation and look at collateral. And you say, okay, well, why, what does that matter? It matters because sometimes they will say that if you, when you do collect those accounts receivable, you must pay the bank, whatever accounts receivable you collect. And so you will be looking as an auditor to see, did they do that? So as they collect those accounts receivable, give it to the bank takes that off as collateral and counts that towards payment of the loan. All right, let's stop here. We're not gonna get through it. On the same page, I don't even know. All right, let's say stop and be back at, not stock, stop. Let's say be back at, what's 10 minutes from now? 7:02? And we will look at confirmations. I'll check something. Add something to this. blah, blah, blah. Okay, I'm going to briefly talk about international standards of accounting, international standards of auditing. They're two different things. So international standards of accounting, there are some conflicts. What I mean by that is there's sometimes that the US standards say do this, the international standards say do that. And usually those are actually usually fairly rare, fairly small, but they do conflict sometimes. Auditing standards generally don't conflict. They're different, but they don't conflict. And we're going to run into that now. And here's the thing to remember about international auditing standards and US auditing standards. It is possible to adhere to both of them. They don't conflict. You can actually do the audits to both standards. Because usually they are a level of they don't say don't do it this way. Right? They usually allow for things to happen, and that's what we're going to look at for the auditing standards. If you are doing an audit that has any part of the audit done in the United States, you have to follow US standards. So you may be doing an international audit. If any of that audit is in the United States, it has to follow US standards and international standards. It has to follow both. Now, if the entire audit's done, internationally, you don't have to use US standards. But if any of it's done in the United States, you have to use US standards. You are held to the US standards. The CPA license is by state. You get whatever state that part of the company is in has to follow the US standards, and you are licensed in that state. You need to follow your state laws regarding that audit. All right. Let's see here. Sure. Hate sharing. Okay. Confirmations. So these are positive and negative confirmation requests. In this case, we're going to look at accounts receivable confirmations. US standards require them. International standards, they are not required. Now, the international standards do not say don't do these. They just say they're not required. You can find some other way to verify these accounts receivable. For instance, bill of lading. You can look at the bill of lading to verify accounts receivable. US standards say, no, you have to do confirmations. So if you're doing an international audit and any of it is in the United States, you have to do confirmations. Now, notice that does not violate the international standards. They just say it's not required. If you do it, they're, and they don't say don't do it at all. But I'm sure most audit firms do the confirmations, but they are not required. The international standards are a little bit more judgment oriented rather than the US ones are do this, don't do that. But generally, again, these don't conflict. You can actually follow both of them. And some of the international standards are tighter in the United States. For instance, short-term financing has to be done by year end for international standards. US standards give it until the audit report is issued, which is later. Now, you can comply with both of them by making sure that they have the short-term financing is refinanced before year end. That satisfies both standards. So, okay, positive confirmation. Positive confirmation. are sent to customers of the client. Okay, positive confirmation is sent to the client to examine the existence of accounts receivable. Oops. So we want to see that they exist. Oops. All positive confirmations must be returned. So all positive confirmations must be returned to the auditors. Negative confirmations are similar in that we are looking for the existence of, no, that hasn't changed. However, which confirmations are you really interested in? The ones that are okay or the ones that have problems? Yeah, ones that have problems, right? I mean, you're looking for problems. If everything's okay, you're fine with that. So negative confirmations are only returned I should say to the auditors if there's a problem. So we say, well, here, let's look at them. Okay, positive confirmation example. I don't know what pages I have these on for years. So this is what they would look like. You'd send these out and you're sending it to a company. Oh, it's an old audit, 2023. Here's something though to pay attention to in that, yeah. Oh, sure. And by the way, you guys, just, in this class, you can go ahead and take pictures of stuff or record it too. I don't mind it at all. I think, let me see here. Will it still sign me in? I don't know if I told you guys this last time. I also record these. Did I tell you that? No. Yeah. So just so you know, if you do miss a class or if you do, or you want to can't remember what I said or what was on or whatever, you can look at you can go back and take a look. No weird formatting on that, but anyway. All right. So here's what a confirmation looks like. Now it'll have the client's letterhead. So for instance, if we're auditing IBM, it'll have IBM's letterhead. why doesn't it have the auditor's letterhead? You know, for a CPA firm, why don't we put our letterhead on it instead of the clients?
We kind of personalize each, but the confirmation. Right.
Yeah, if you know, whoever they're saying this to Matrix Enterprise, whatever, if we put our letterhead on, they're gonna say, we don't have any business with, with, you know, Joe's CPA firm, you know, they, you know, could ignore it, but if they have the letterhead of the client on there, they say, oh, okay. So here's what they would have, is say, okay, as of the year end, we have these. And is this amount indicated correct? Yes or no? If it's not correct, you know, if it's a no, explain why. And then please return the confirmation, blah, blah, blah. Okay, so this is a positive confirmation. We have to get these back. Now, this can take some work to get these back because, you know, people don't fill them out. You got to call them up. You send out 100, you get back 87. You send out, you know, the other 13 again, you get back 4. You make a call. Oh, yeah. Okay, I'll send it in the mail right now. You get back a few more. And finally, you get down to the last 2 or 3 and you say, okay, are you by a fax machine? All right, good. I'll wait by the fax machine for you to send it. Don't hang up. You know, do you get these back? And usually they go by the invoice because that's usually what you'll be, you know, we expect to collect. And it could be that they're not paying it because there's a problem with it. So you have the invoices on there. And then return it directly to the CPA firm. It'll go directly to the CPA. It will not go to the client. It will not go to IBM. It will go to the CPA firm. All right, and we do the same thing with the negative ones. However, it's a little bit different because we say if the amount is incorrect, scratch it. If the amount above is correct, please disregard this confirmation. We only want the ones back that are bad. You know, those are the ones we're going to be interested in. There is a problem, though, with the negative ones that you don't generally have with the positive ones. And that is, suppose you don't get it back. Would you be correct to assume that everything is okay? No, they may not have gotten it. It may have got lost in the mail. It may have been sent, you know, to the wrong address. It could be that, you know, they got it and they looked at it. Oh, this isn't right. These guys are idiots, and they threw it in the garbage. So you can't make any judgment based on what you didn't get back. The only thing you can make a judgment on are those things that you did get back. You know, okay, it looks like there's a problem with whatever. So you're only looking at those things that you did get back. You cannot make any you know, judgment based on those ones that were not returned because you don't know why they weren't returned. They went to the wrong address. Could be when they sent it to you, they got lost. You got sent lost getting to them, or it could have got lost being sent back to you. So you can't make any. So there is a problem with the negative ones, and that if you don't get it back, you really can't make any judgment based on that. So having said that, which confirmation is better evidence, the positive ones or the negative ones?
Positive.
Positive. Yep. Okay. And you don't always use the best evidence. And here's an example of it. Suppose you have 2 options for confirmations. The positive ones, which are better, right? These are better confirmations. I gotta sneeze. Okay, I don't have to sneeze. So let's say that we'd be just as happy with these 2 alternatives. Option A is 100 positive confirmations for $20 each. Or B, now we have to send out a lot more because this evidence is not as good. We could send out 500 negative confirmations. And the cost of it. Now, it will be just as happy either way. Which one are we going to do?
Option A.
Okay, option A is going to cost us, let's see. Oops. 100 times 20 is 2,000. And option B, 500 times 3 is 1,500. So if you're just as happy either way, you're probably going to end up with this one. I'm allergic to autotone. Okay. And so this is one thing about evidence. It's also true, not just in this case, but sometimes we don't always get the best evidence because it's too expensive. And remember too, there's also a time thing and it comes into play here, but also you're dealing, these costs get passed on to your client. It's in some way, shape or form. So you're also cognizant of trying to keep it economical for not just yourself, but also for your client. Okay, when are they appropriate? Well, positive ones are more expensive and they're, you have to track every one of them down. These are usually appropriate for, you need to know this for the test. Appropriate when there are large dollar amounts and few accounts. So large dollar amounts and few accounts. So a large dollar amount, especially if these accounts are material, you want a confirmation on it. These are millions of dollars of accounts, and any one of these accounts could be material. You got to get all of those back. So what are the negative ones? Usually there are small dollar amounts. And many accounts. And the idea is, look, if you don't get some of these back, they're probably not material anyways, and you'll probably get back enough information to know if there's any significant problems with it. But the positive ones are used for large dollars to your accounts, and you got to track every one of them down, and it's going to be a pain. But again, if you're talking about millions of dollars, it's worth it. And the negative ones are for small dollar amounts and many accounts. And again, the idea being you'll get enough of them back, probably that will tell you if there's a problem somewhere. But if someone doesn't send it back, it's probably not material. One last thing on these, and that is the confirmations are for the existence of accounts receivable. They are not very good at showing the true value of it. So these don't show you the value of the accounts receivable. They only show you that they exist or they don't exist. And even if you do this, you go, oh, okay, well, what about we sent this out, it's got these guys, they said it's okay, let's say there's a positive one, they sent it back, they say, yeah, that's fine. There's a problem with that even. Maybe there's a fourth invoice that you didn't put on there, and they may tell you, they may not. Hey, they're missing that $10,000 invoice. Don't say anything, So it is possible that they don't say anything. It could also be, yeah, those are correct. Oh, by the way, we're filing for bankruptcy on Monday, and you're not going to collect any of it. The value of this is zero. Yeah, the amount is right. That's fine, but you're not going to collect it. So these do not tell you the value of an account. They just tell you whether they exist or not. Okay. these are the um, these are for all the accounts, actually, the relevant assertions. Yeah, there's different ways to remember them. But coming down here, which of the assertions are aided by the accounts receivable confirmations? By the way, all of auditing is to these assertions here. We're always looking whether these are. Oh, I just talked about this one: existence or occurrence. How about number two? Which assertions are aided by the sales cutoff procedures?
A.
Uh, could be. These are usually yeah, where they actually put it. You could have something in there. The one that is definitely they're going to have is this one, the completeness and cutoff. And by the way, cutoff is a new one. It used to be um, assumed up here. So sometimes you'll see this also shown as this one. Did the sale occur by year end or not? So sales cutoff procedures oftentimes we cut off, which was added to it. They used to be in these two. But yeah, so those are probably the two that are mostly. All of these, to some extent, are going to be with all the accounts, and almost all the procedures to some extent will be in there. But the main ones here are going to be the existence or occurrence. Did the sale actually exist at year end or occur? And the completeness and cutoff. You get all the sales. Did they exist? And the cutoff too, it could also go the both ways, that they shipped something and they didn't count it as a sale. Which sales and accounts receivable assertions are aided by analyzing the cutoff bank statement?
D.
Yeah. Yeah, and it could also be the oh, I already did this one. Are confirmations required by US? And I said yes. I thought I had the further thing. International standards, no, they don't prohibit it, and they don't say don't do it. In fact, I bet that almost all of them do confirmation, especially on large accounts. Who should be able to write off accounts receivable? It's possible they have a credit department that does this, but if it's not, a lot of times they say who can write it off, and it should be it could be almost anyone. Except salespeople and accounts receivable people. Yeah. Okay. Clearing the audit. Another thing about auditing is they do what they call clearing the audit points. And this is a pain for almost anything. Whenever you find a problem, you need to clear it. And the clearing it could be that you talk to people and get them to change the account. It could be that you just determine that it's immaterial. It could be whatever it is. But clearing the audit points is always a thing. So if you find 10 things that are wrong, you have to clear all of them. So whenever you get a response back for these accounts receivable confirmations, you have to clear them. Okay. We never received the last shipment listed. How would you clear that? What is the one document you use often for the shipping?
Bill of lading.
Yeah, the bill of lading. Oops, wait, I said that wrong. Now, the bill of lading is probably going to be your most important one to determine if something was actually shipped. You may also get the proof of delivery. But notice that the bill of lading, it actually shows that they actually shipped it. Now, again, maybe it got lost in shipping or maybe whatever. But you're gonna look for bill of lading, proof of delivery, and you can get those from the shipper themselves. So if there is a problem, the bill of lading is really your go-to because that shows that there was an effort made to ship it. Whether it got there, that is another question, but okay. Number two, and this one I think I'm going to take because I don't think we talked about it. We won't talk about it until inventory, which is I think that's the next chapter. Well, I think is inventory. About 3,500 of this invoice have been returned on. You would look for a receiving report. Right, and that you would also have a return material. Authorization. RMA. So if you have a return material authorization, usually that's the first step is you get a return material authorization. That means that whoever you bought it from, whatever, will be expecting it to come back. And you look for a receiving report to see if they actually sent it back. You might issue a return materials authorization, you have no receiving report. But they need to have both of those. And if they just send something back, oftentimes, if they just put it in a box and send it back, you may not know who it is or what it relates to, or if they even can send it back. 3 is a funny one. I paid this already on 1/6/2024. Now, notice that these are account responses as of 12/31/23. So we're saying as of 12/31/23, do you owe this? And this guy sends it back and he says, hey, I already paid this on 1/6/2024. What's mildly funny about this one?
The date.
Yeah. This is actually a confirmation that it was a valid account on 12/31/2023. They paid it on the 6th, so it must have been valid. This is actually a confirmation. Now, it's possible that you want to see if they actually sent, the check and all that kind of stuff. This is a confirmation, but if you wanted to see if they actually sent it in, you can look at the, what you guys tell me, what would you look at? Yeah, you could have a cut-off bank statement, but you could also have, the confirmation is, if you want to see if someone sent you a check, make sure that you got a check. What would you look at? Checklist, yep. The checklist and deposit slip, either one of those should have it. You really, generally speaking, though, this is actually a confirmation that, well, this is actually, yeah. This is actually a confirmation, though, that it's everything's okay. It must have been valid on 12/31/23 because they paid it on 1/6/2024. Not our order. The entire order from 12/12/23 was returned on 12/15. This is another company's order. Your company is stupid. What do we do with that? Probably the same thing as up here. If they said that it was returned, we would look for receiving report, return material authorization. And who knows, maybe the company is stupid. You never can tell. Number 5, the most irritating ones. Actually, 5 and 6 are the most irritating ones. This total seems too high. What are you gonna look at for this one? Now, notice that they're not saying I didn't get this. So they're not saying this wasn't delivered, I never received it, I didn't order it or whatever. It says this total seems too high. Yeah, you probably look at the invoice. Compared to the invoice, you may even compare the invoice to the bill of lading just to see if it was actually sent. But yeah, checking the invoice and seeing if it was in any other documentation that they have, if they have sent a customer order or any whatever. But sometimes you just get weird stuff like this. Number 6, for company policy, we cannot disclose private information about our vendors. This is a company run by lawyers, I bet. So they're not going to respond to it. Yeah, you probably do the same thing. Bill, the invoice would tell you what was the amount that was invoiced, and the bill of lading should match up to the invoice and show you what was sent. And that would probably, if that ties out to what was sent on the confirmation, you'd probably be happy with it. Okay, number 7, we picked up at will call and paid cash. We don't owe anything. A copy of the cash receipt was. This actually kind of harkens back to chapter 10 also. We picked this letter up at will call. Does anyone know what will call is? Will call is when usually it's a local sale, and companies, you can order stuff and they'll ship it. But if you're local, you say, okay, well, hey, I'm already in Chicago and you guys are in Chicago. Can we just come pick it up? And they'll say, sure. We go to the will call place, and so they'll have all these orders sitting in will call, kind of like what they do at, during the pandemic. You could order stuff and they'd go, you can go pick it up. kind of the same thing as like the pandemic, you go pick up you order all this stuff, they get it all together and you go pick it up. Okay, we picked this order, but we'll come and pay cash. We don't have anything. Copy of the cash receipt was returned with the envelope. Okay, this one is actually could be a problem. With cash receipts. So this is one that you'd actually want to look at because somehow, the question is what happened to the cash? And why is there an accounts receivable, why was there an accounts receivable generated for this? So this one is actually, while it may not sound very serious, it could be a problem with either someone stealing cash or some clerical problem that they have with. And notice if there is a clerical problem, people say, oh, okay, good, it's a clerical problem. There's no, actually that's bad because that shows you that the controls are not working. That's something that shouldn't happen. And if it is, that means you don't know oftentimes if there is a problem, someone is stealing cash, for example. Maybe no one's stealing cash, but maybe they could have. Okay. Last thing. Yay. I think it's on one page. I gotta update the years on it. I guess that's not so far back, but okay. So this is the information from the sales journal, and they show the amount. So this is the amount that was sold. They said as of 12/31. These accounts were sold. These were things that were sold. However, where as auditors, we want to go and see if these are the last one. And we have the bill of lading numbers. We have the invoice, bill of lading numbers. Okay. So let's take a look at these and see which ones we can clear. Now, notice that down here, these are the ones that are the last ones that cleared on 12/31 are right there. And I am going to get mine a little closer together so I can get them on one screen. Okay. So let's take a look at these bill of ladings and see which ones we can verify. 3782. Was that at year end? Yep, that's this one. 3783. Yep. Oh, no, don't do that. Sorry, I must have hit the wrong key there. 3783. 3784. So good so far. 3785. Okay. Well, what are we going to do with that? Notice that what we get, the bill of ladings at year end, what the mark of the bill of lading does not match up with the date on the invoice for a few of these. How are we going to adjust our books? Or how should the client adjust it?
Maybe make a journal entry.
Yeah, go ahead. Let's look up here. Which one of these is not a sale? This one is not a sale, right? So how are we going to adjust our sales for that one? Will that increase or decrease the sales? They're saying it was shipped out on 12/31. Do we say when it was shipped out? What was that? 37/87? So they didn't ship out 37/87 until the first of the year. So that was not a sale at year end. So for our sales, would that be a plus or a minus? Minus. So we're going to subtract out the 2,100. That was not a sale. There's one more problem though. What is that? Yeah, this one was a sale. So this one was a sale. So will that add to or subtract from? Which one? I'm doing something wrong here. Okay, there we go. So this one actually was a sale. This would be a plus. So our adjustment to our income, or I said, well, actually, it would be, well, no, because it could be cost of goods sold in there. We don't know about. But as far as the revenue are concerned, and the accounts receivable, so what's minus 2,100 and plus 400? What is it? Negative 17? It's negative 17. Did we get that? Ah, I know not that much. Okay. So are the regular the revenues? I'm making up words. The revenues, something called regatives, are overstated by $1,700. Oh, wait a minute, I did this wrong. This should go down here. By the way, if you ever do this on a test, if you just draw an arrow, I'm going to copy and paste, but which one should have been included on there? It should have been those are the ones that should have been included. And what we necessarily change in the year end. What time are we at? We're getting close. I'll let you guys do this one on your own. This one you guys can probably turn it. You guys can do this without me, sure. So complete, and then and then you can turn this in. Oops. And I want to talk about one more kind of thing other than this. So you can complete and turn this in. It's similar to what we just did. Strikingly similar. You're going to get one of these in the test too. Okay, what I want to talk about though now is the test. So I sent out the test last week. It's due tomorrow. And do you have any questions on it? And those of you that have already turned it in, until I put a grade on it, you can still turn in you can still turn in, if if I say something that you say, oh gee, I wish I knew that, you can actually just change it and turn it in. As long as you turn in the test before I put a grade on it, which I won't do that until probably Saturday, you can turn it in. You can turn in multiple, tests if you want. So, and what I usually do is I just go to the last one. If that one's okay, then we, keep that. I will look at the other ones too. But I generally, if someone turns in 3 documents, I assume that the last one is the one they really want me to look at. So that's what I go to first. But so is an exam as long as you turn it in. Now, as far as the homework is concerned, you can turn that in if you're missing points on it. You can turn that in at any point during the term. You just turn it in again, it'll show up on my screen as a second attempt, third attempt, fourth attempt, whatever. And you can turn those in at any time. The test, after I grade it, you can't return them. You can't turn them in after that. Are there any questions though on oh, okay. Are there any questions on the exam, the chapter 10 exam? Any part of it that you're unsure of, that you want clarification on or anything? I don't mind talking about, I won't be able to give you the exact answer, obviously, but we can certainly talk about where you'd find it or what they're talking about, when they ask for this or that or the other thing. Virtually all those questions are CPA exam questions. And you actually, I imagine the solutions are probably out there because most of those are. The neat thing about auditing is though, even though things change during the year, the actual process of auditing is pretty much exactly the same. If you're doing, if you're sending out confirmations, it's the same. Those are the same confirmations they sent out in 1962. And the CPA exam was an open exam until 1996. It's going to be exactly the same. So there's all kinds of stuff out there. There are real CPA exam questions out there, decades worth. And for stuff like this, again, this stuff hasn't really changed. The stuff we're doing in this class is the same stuff that I went through doing 30 years ago. Any questions on chapter 10? Okay. Well, I will send out the chapter 11 exam tomorrow. And finish up this one, finish up L, and you'll send it in. It's exactly the same as one here. And yeah. And that'll be it for tonight. Any questions? No, I was gonna say, don't say anything. Hit you with a shoe. Okay, well, I will see you guys next week, and you guys stick around. I will check your stuff in here, and have a good weekend.
Have a good evening.
Good night.